Hi, good evening and welcome to our latest AJ Bell webinar, Why You Should Consider Combining Your Pensions. I'm Charlene Young, Senior Pensions and Savings Expert here at AJ Bell. So I'm part of the team that brings information direct to customers on all things personal finance, tax and investing. You might have seen myself or some of the members of the team commenting in national press and some of the members of the team even on television regularly too. So pensions are one of my specialist areas, and tonight I'm here to talk about why people combine their pensions together in a single pot. My talk isn't formal advice, but I'm really hoping that whatever stage of your retirement planning you're at, it will give you the confidence to find out how much you might need, what you've already got, and show your pensions some love. So let's begin. So this is what I'm going to cover in the time I've got with you this evening. I've got about 30 to 35 minutes to go through this, and leaving around about 10 minutes at the end for the questions that you've already really kindly sent me in. So we're going to firstly look at how much do I need to retire, then move on to lost pensions, then the benefits of combining pensions, and then how you can actually go about combining the pensions before that Q&A that I mentioned. So why are we running this webinar? Why am I always looking to improve the information we give to AJ Bell customers on pensions? Well, it's because people are overwhelmed. Latest statistics show that 51% of people don't know how much money they'll need for what is being labelled a comfortable retirement, and 60% of people fear that they will outlive their savings. Now, obviously, comfortable can mean different things to different people, which is probably another reason why some of the confusion arises when we're talking about pensions. So onto our kind of first main section, how much do I need? So this figure, I guess, will be personal to you, but it can still be tricky to pin down. To get started, you could simply assume you'll need a fraction of what you spend now. Or you could go a bit further. If you want to drill down a bit further into the detail, you could look at different pockets of spending. Some might fall away in retirement, so commuting or childcare costs, for example, or any red lines that you'll have, so things like not cutting down on holidays or eating out. And those things actually might increase in retirement and you might want to spend more on them. So it can be as simple as looking at a fraction, or you can drill down into what you're spending now to give you a ballpark figure. So we've also got some really handy figures from the Pensions and Lifetime Savings Association, or PLSA for short. So what they've done is decades of research and to put a cost on what 3 different lifestyles might cost someone in retirement. So all the way from a basic minimum, covering just the essentials, to moderate and then comfortable. So you can read more about what's included in the figures at the retirement livingstandards.org.uk. But it's worth pointing out that these 3 measures have no rental or mortgage costs, and they're all in today's money, which means they take inflation into account. So these 3 figures that you can see on the screen now are 3 different yearly incomes according to the PLSA for a single person living outside of London. They've also put together figures for couples, which are around £8,000, £12,000 and £16,000 a year more than each of these single figures for the minimum, the moderate and the comfortable retirement respectively. So what varies between the different types of lifestyle here is the amount that you might want to spend on food, clothing, leisure. To give you kind of a good example, the minimum living standard assumes 1 week-long UK holiday per year. That might not tally with what you have in mind for retirement, what you'd like to do. At the other end, that comfortable living standard budgets for a fortnight-long 4-star holiday in the Med with spending money, and then also 3 long weekend breaks in the UK. I've just used holidays there as that's kind of the thing that I like to spend some of my money on. You might find your preferences are different, obviously, or they might be in the middle of 2 of these standards for lots of the different assumptions, but they're a really great place to start. So I'd encourage you to have a look at the kind of data there, and it might just help you put some numbers behind what you might need in retirement. So sticking with what do I need, let's take that moderate lifestyle for a single person that we talked about. So £31,300 in today's money. how does it pan out if you take into account things like the state pension, which is, an important bedrock of people's retirement funding? So currently, the full new annual state pension is worth just under £12,000 a year if you've got that full 35 qualifying years towards it. So for the moderate retirement lifestyle, using those PLSA figures, there's a difference of just over £19,000 that, does that difference need to come from your retirement savings if you're aiming for that figure? If we think about the couples living standards that I mentioned, it's actually just over £20,000 between you if you can deduct 2 full state pensions, so much less than double, and kind of really emphasising the impact of what we sometimes refer to as the single tax. So it's fine having that kind of required income, but I think what sometimes people struggle a little bit with is how much does that actually mean in my pension pot? So I'm aware that these are really big numbers and can probably feel quite daunting, but these are the pot sizes based on a number of assumptions to generate that £19,327 after tax for the moderate living standard once we've taken off a full state pension. So for comparison with kind of previous years of this research, the PLSA have used the assumption that somebody buys an annuity with their pot. So an annuity is just a way of securing or guaranteeing an income for life. It's one of the options at retirement. Now, we know, of course, that most people don't do that anymore, and you might want to be more flexible with your income and your spending when it comes to accessing your pension. Lots of people, for example, like to spend a bit more in the early years of retirement, and then they find they wind down slightly on some of those other things. It isn't necessarily linear, is what I'm trying to say here. So these pots also don't take into account any other type of savings you might have towards your retirement, like ISAs, for example, which we know, if you take an income or take withdrawals from them, they are tax-free. So to target that shortfall between the state pension and the moderate living standard, the PLSA estimate that someone would need a pot of between £350,000 to £400,000 to do that on their own. If we toggle to the comfortable, so that higher income in retirement, that comfortable living standard, the pot size required goes up, this time to between £500,000 and £600,000. Like I say, I'm aware these figures are quite daunting and they are looking at that individual living standards. If we think about the couples living standards that I mentioned before, the pot size each, if you were in a couple at retirement, would be around £200,000 each for the moderate lifestyle, and around £365,000 each for comfortable. So again, it's not double if you're in a couple. Again, kind of maybe emphasising the weight of that single tax. So why do we have what some people refer to as a lost pension problem in the UK? Now, auto-enrolment has done wonderful things to get more people saving into pensions. Many of us think it could go further, as too many people are perhaps assuming that the minimum contributions are enough to kind of get them towards retirement. And as we've seen, some of those figures are perhaps higher what you might need in your pot than you were expecting. Now, with auto-enrolment, people start a pension when they join an employer, but when they switch an employer, they often leave their old pension behind, perhaps neglected and slightly unloved. Now, this has created lots and lots of small pension pots which are easily forgotten. People changing jobs potentially 10 times in their career, much more prevalent within younger generations these days. It's easy to see how the number of pots lost or forgotten about can really start to add up. So looking at those figures there, so the Pensions Policy Institute has estimated that there's 3.3 million lost pension pots in the UK, coming in at an estimated value of just over £30 billion. So you can see the effects here with auto-enrolment. The size of the value of these lost pension pots, although just an estimate, has been projected to rise, to have risen by 60% since 2018. Pension companies can change around too. Even working in financial services, it can be hard to keep track of what a provider is called compared to what it was 20 years ago. So whilst you might not have completely lost a pension, you might just have lost track where it is or what it's invested in, or even just what it's worth, even if you know where it is. So how can you find these lost pensions, or how can you track down pensions you think you had, but you're just not quite sure what they're worth now? So Most people have a CV to hand or know where they've worked in the past. So the first thing to start with maybe is a record of where you've worked and thinking, yeah, actually, perhaps I did have a pension there. Let's track it down. Now, firstly, I've put paperwork there, but let's bear in mind that those statements might have moved online these days. We talk about paperwork quite a lot and it being a bit of a burden, but actually if you have that stash of paperwork hidden somewhere, that might be a good place to start. So when you've looked at your paperwork or your online statements, are any pensions missing when you're thinking about where you've worked before? If you're not sure, you can get in contact with your old employer. They might be able to give you the details of what pension that you were in or where the pension is now held. There's also a free tracing service from the government. And finally, I've mentioned use a pension finder tool. Now I'll come on to that in a second. We have one here at AJ Bell. So pension dashboards, you might have heard about this in the news. It's something that governments have been trying to introduce for years and years now. Now they potentially could have a really big role to play, allowing you to see all your pensions in one place online. And the aim there is to really unite people with their pensions and kind of re-engage them with them. But the government still needs to set a date for the actual launch of the dashboard, and it remains to be seen if it's ever really going to yield those results. So as I mentioned, some providers have free pension finding tools. We have one here at AJ Bell. So I've just put a little screenshot of what that looks like on our website. You can find it if you pop to our website and look in that main menu and find my pension, and I've just popped the address at the bottom here. It's got records of different employers, where different employers have moved to, what they're called now, where they held their pensions, and like I say, what they might be called now. So that's the employer or the pension provider. It's been running for nearly 2 years now, and we also had a look at the pensions it has helped people to find. So 1 in 10 people who used our tool found 4 or more missing pensions. Whilst the average found pot was worth over £10,000, many people found more than one pot, so putting the average amount found per person at nearly £18,000. Those values actually were different by age bracket, perhaps not surprising. So people in their 40s found around £23,000 on average, and rising to an average pot of £33,400 for those over the age of 70. So that's not really a surprise. I guess people who were older have had longer to pay into those pensions. They've been invested for longer. And there is the potential to track down much larger pots, and we've seen that in the research. So the biggest single pension pot that somebody discovered was worth over £650,000. And the biggest total fine for one person, so multiple pots, was over £950,000. That could get you really close to potentially that comfortable living standard in retirement that we mentioned earlier. So if you want to get started with that, you can navigate to our website, and there's just 3 easy steps to start finding and potentially combining your pension. So why bother? What are the benefits of combining pensions? Well, I'm going to go through 5 of them with you tonight. First up, we've got easier management. So one pot means it's far easier to keep an eye on your total pension savings and estimate what that could give you in retirement. So this will help you make informed decisions like how much you could increase your contributions by, and how much more you could potentially get in your pension pot. Secondly, having them more in one place means it's easier to get hold of the information you need to crunch your own personal pension numbers. There's fewer statements to wade through and only one online login potentially to remember. So again, just helping you find that information you need to check you're on track. Thirdly, investing choice. Now this will depend slightly on where you are in your journey and how much you want to be involved with choosing your investments. So for example, our SIP gives you access to our full range of investments if you want to choose everything yourself and you're comfortable with that. We've also got a ready-made pension where you choose from a much more tailored range of AJ Bell funds that are managed for you, and actually any cash that's paid in, including found pensions, is automatically invested into your chosen fund. So there's an investing choice to suit you, and you could potentially get much greater choice if that's something that is important to you. Fourth up, more options in retirement. So if you're combining, like many people consider doing in the run-up to retirement, the SIPP will usually give you much more choice as to how you can access the pension than perhaps having different pots elsewhere with different providers, as well as who you can leave it to. Now, I did promise you 5 benefits, and the 5th one is a biggie and relates to charges. So combining your pensions in one pot is often triggered by people trying to reduce the charges they're paying on their pensions. So there is actually a cap on the charges that people should be paying on their workplace pension if they're invested in the default fund. It doesn't apply to other funds that might be available in the pension, and it certainly doesn't apply to kind of older pension plans that you might have. And to illustrate the effect of charges and what that might mean for your pot as you get closer to retirement and you're thinking of turning it into an income, just like investment returns, the effects of charges really compound over time. So with this in mind, we looked at how much somebody with 3 pension pots, just 3 pension pots, worth £25,000 each, one charging 0.75% a year, one charging 1% a year, and the third charging 1.5% a year. How much could they save by combining them into one plan, charging 0.45% a year? Now you might think, well, hang on, that figure's way lower, you've under-egged it there, but that's actually our simple all-in charge for the ready-made pension. So in the table there, you can see the difference in total value of the pensions over 10, 15, and 20 years by combining them into that single lower cost pot. So if we look, for example, after 15 years, that person would have potentially £13,166 more in their pot compared to if they've not done anything. And after 20 years, again, looking at that compounding, it's nearly £21,500. So why now? I mean, perhaps I should say why not now? But these are all examples of common life events where people choose to start looking at their finances, sometimes through necessity rather than choice. But as those potential cost saving figures show, the longer you have to make savings, the greater the impact. So maybe you like the sound of tracking down some lost pensions, maybe combining them sounds good to you. How do you actually go about it? Well, we split it into 3 simple steps. The first one sounds kind of obvious, find them. So check for any of those pensions you might have lost track of. We went through plenty of different methods earlier in the talk, as well as pension finder tools from providers. Second up, check for any guarantees, any special features that you might have in your existing pensions. Typically, this will be more common if you have some older pension plans, older style pension plans, but not necessarily always. It's just about arming yourself with as much information as possible to help you make an informed decision. Now, of course, another thing to check here is the charges that you're paying. So if it's not clear, speak to your provider. They should be giving you an annual statement detailing the charges that you're paying. And lastly, give your provider the details to begin. Now, this will vary slightly between provider, perhaps if you're using a pension finding tool or a combining tool, but speak to your chosen provider to get started, and then they should be handling most of that admin load for you from here. Another decision is how to actually transfer the money if you've decided to go ahead. Again, this is kind of split into 2 methods. So you can transfer the pension money as cash. So that involves selling the investments you hold in your existing pension first. You might have to do that yourself, or your provider might do it for you if you've told them where and when and how you want to transfer. So again, another thing to keep an eye on. Some people do this because it's quicker to transfer the money, but obviously there is the risk there that you are not invested for a while and you're what we call out of the market. So it's just one thing to bear in mind. There is the option in some cases to transfer the investments and any cash as they are. So this helps you keep the investments. If the investments you'd like to keep, you just want to move them to your new pension and your new provider. But your new provider needs to be able to hold these investments. So again, as part of the process, that new provider will generally check, if you've told them you want to keep the investments, that they can actually hold them and communicate with you throughout that process. You might see that referred to in specie or in specie in your provider paperwork. Now, before I finish the kind of main presentation bit of today, I've mentioned some special features about existing pensions. So here are examples of the types of pensions you probably shouldn't transfer. So first up, something called defined benefit pensions. Now this includes the most kind of common or well-known type of defined benefit pensions known as final salary schemes. These are pensions typically in the public sector, but not just there, that are guaranteed for life and sometimes also pay a pension to your dependents, your spouse, for instance, when you pass away. It's very rare that transferring these days is a good idea. To do so, to even explore transferring a pension like this, you'll need specialist advice where the scheme or the benefits in the scheme are worth more than £30,000 on transfer. As I mentioned, final salary schemes are probably a well-known example, although many schemes, particularly in other sectors, have moved to something called career average. Now, some of these public sector schemes that I've mentioned, so for example, the NHS pension scheme, you cannot transfer, that is the law. So it's just worth mentioning and bearing in mind you might have some old private defined benefit pensions. Now, there's other types of pensions that come with valuable benefits. So, for example, guaranteed annuity rates, or the ability to take more than 25% of your fund tax-free. So that tax-free cash we sometimes talk about, for most people it's limited to 25% of the fund, but in some older types of pension, people did have the right to take more than that. Now, just keep an eye out for whether that is something that your scheme offers. And thirdly, some schemes have the option to access your pot early. So currently, the age at which you can access a private pension pot is 55, but this is going up to 57 from the 6th of April 2028. Now, guaranteed annuity rates I've mentioned there, it's probably worth just mentioning what they are. So they are a fixed rate in which you could use to convert your pot to an income when you retire, and they're normally separated out with different rates at different ages. If you transferred that plan, those guaranteed annuity rates, they're typically higher than what you would get on the open market if that's something you're thinking about, but you would lose them upon transfer. Sometimes there are ways you can keep the other two benefits by transferring, but it's an area where if you're thinking about it or you're making that kind of decision, it's an area I'd really suggest that you get some independent financial advice. And then thirdly on that list, beware exit fees and adjustments. Now, a lot of exit fees have been consigned to the dark ages, but there are still some out there. And for those, it will be about the level of the penalty. So if you've got a smaller charge and a decent time to retirement, you've got a greater chance of making back any kind of fee or adjustment. And an even more chance if you're moving to a plan that is lower cost year on year. But you need to ask the question. So I mentioned pension finder tools a lot tonight. For example, our own pension finder tool will request this type of information from your existing providers as part of the finding process. Our tool will then prompt you to read it and check through the details and confirm you understand these special features and that they might be lost or they will be lost on transfer on a found pension before you can actually move forward. But it's important to kind of arm yourself, as I say, with all that information so you can make the best decision for you. Right, congratulations if you've made it through. Now, when you signed up for tonight's webinar, we asked you if you had any questions. I've got about 10 to 15 minutes to see how many I can answer. If I don't get to your question and I'm not able to answer it tonight, I will do my best to have another look through what we've got in and see if someone could come back to you. I can't obviously give personalised advice though, and so for that reason, I won't be reading out the names that were sent in with the questions tonight. If you do want to know a bit more about the best action for you and your personal circumstances, I won't be able to answer that, and again, that's probably something you should talk to an advisor about. But let's have a look at what we've had in. So first up, the first question we've had in, what are the key questions you need to ask before transferring a pot from one pension company to another? I guess first up I would think about is charges. So have a look at the charges you're currently paying. It might be an all-in charge or they might be separated out. So you pay an account fee, for example, or sometimes called a custody fee, and then a separate charge for the investments that you hold, or like I say, it could all be in one. And obviously ask the same question or have a look at the charges that you'd be paying under your new provider for the services that you are aiming to use. Second up, again, going back to that, does my plan have any guarantees or valuable benefits that might be lost on transfer? So again, looking at those guaranteed annuity rates, whether or not you could access your pension pot potentially earlier than you could under the general rules. And again, whether there's any exit penalties as well. We talked about that. So if your existing pot is invested in something known as with profits, it might have a market value adjustment or reduction if you transfer away. Again, it's all about kind of arming yourself, I should say, with all that information to make the best decision. And actually, just one final point, I've just thought of, if you want to keep those same investments, can your new provider accept them? So going back to those two methods we talked about transfer, whether you would transfer the benefits in cash, so sell those investments first, or if you're looking to keep the same ones, can you actually move them across? Next up, I started a pension age 45. I currently pay in 4% of my salary and my employer pays in 6%. Would a salary sacrifice be better? Right, well, that's great that you started. That extra 6% from your employer would be lost if you weren't paying in 4% of your own money. You'll see it referred to quite a lot when we talk about pensions as kind of free money on offer from your employer. You wouldn't get paid that otherwise. Now, salary sacrifice or salary exchange, to kind of give it its official name, involves you exchanging a little bit of your pay in exchange for a non-cash benefit, in this case, a pension contribution. So in terms of income tax, it would work out the same for you whether you were using salary sacrifice to pay your pension contribution or whether you were just paying it in yourself as you currently are. But salary sacrifice does potentially save you a bit more in terms of national insurance, and it definitely saves your employer national insurance on that money that you would have got paid and then paid into your pension versus paying it directly into your pension. Now, some employers might actually also pay in the national insurance they're saving by you doing salary sacrifice too as a nice perk, but not all of them do that. So, on balance, salary sacrifice might be better in terms of pure pounds and pence point of view, especially if you're going to get that extra kind of kick from your employer national insurance saving. But you do need to be careful because it does reduce your kind of headline salary. So that could impact, for example, how much you could borrow in a mortgage to buy a property, for instance. So just be careful when you're thinking about that. And also with a lot of salary sacrifice arrangements, they are contractual changes. So you can't kind of chop and change whether you're doing it 1 month or the next. It generally can only be reviewed once a year. And again, it is a contractual change to your terms. We might see more employers looking to offer salary sacrifice if they don't already, due to the recent hike in the amount of national insurance that employers now pay. So next up, what is the easiest way to find any missing pensions? As we mentioned in the talk, kind of look at any paperwork you might have, any online statements, thinking about where you've worked over your career, if you've got an inkling, if you like. But a kind of easiest way, I would say this, wouldn't I, is using a pension finding tool. Does that all for you. And ours, as I'm sure, like many others, is free. And you're no obligation necessarily to kind of take any further action once you've found those pensions. So I would say kind of a combination. If you want to have a think about what paperwork you've got, but use those pension finding tools that are on offer as well. Are there any tax implications that I need to be aware of when combining my pensions? So not specifically with regards to transferring or combining pensions, although some older plans, as we mentioned, might let people take more than that usual 25% tax-free cash, or have an earlier retirement date, so that might impact your tax position, but there's no kind of direct tax implications of making a transfer. If those kind of things don't apply to your existing pensions, I guess I would say combining gives you a better idea of how much of your allowances you have left. So whether that's what you can pay in each year, so your pension's annual allowance, how much you've used of that, it's kind of easy to track down if you've got everything in one place, or what you can take out. So how much tax-free cash you might be able to get from your pensions. Next up, if I combine my pensions with AJ Bell, does this increase the risk if it's a large pot? Is there any FSCS protection available? Okay, so investor protection is available in different cases. So we have got a really in-depth article on this on our website, in something called the Security Centre, going through all the different types of investor protection and FSCS. We'll try and keep it to pensions here. So it's not a straight £85,000 per person or per pension. I think sometimes that comes up. People see that 85,000 figure and think that just applies to their pension. So if their pensions are worth more than that, they think, oh, am I at risk here? So I think, firstly, in terms of AJ Bell, what I will point out is we are one of the largest platforms in the UK. We're listed on the FTSE 250. We are a listed company. You can see our detailed financials and our financial position. But in terms of like the protections that are offered on pensions, so first up, we are an investment platform, but sometimes customers will hold cash, whether that's to pay kind of fees in the SIP or ready to pay income at a later date. So the cash that we hold for our customers, it has to be separate to the business's cash. And the way we hold cash for customers is we split it across a number of different banks. So that means you potentially have access to an FSCS protection of up to £85,000 per banking licence for that cash. So that would protect you if, in the event of a bank becoming insolvent, and it happened to be a bank where we held some customers' cash. So again, we're primarily an investment platform, but protections do also apply to cash. Second up, in terms of pensions and as an investment platform, the FCA has really strict rules on what's called capital adequacy. So this is the amount of money that providers must hold in reserve. So there's rules for pension providers. There's also rules for investment platforms, of which we are both. So we actually hold far more than the minimum, and we are, like I mentioned, subject to both sets of those rules. And third up, the investments in your pension. So again, for pensions, our pension scheme is held in trust, and those investments are held completely separately from our provider's own assets. So if the platform, was highly unlikely, but if it was to become insolvent, those investments can be moved elsewhere. They aren't an asset of the company. And again, as I mentioned, the pension account is held in trust, and those investments are separate. If something happened to one of your investments as a result of any insolvency, the FSCS can step in. So again, it kind of depends what action or what thing you are thinking about happening, but there are various different layers of protections in place for pension investors. Like I said, we have a detailed article available on that on our website as well. Okay, I've heard that tinkering with your pension account constantly isn't a good idea. I would agree with that. But nor is being totally hands-off and never checking it. Again, I would agree with that. So how often should I be looking at my pension, and what should I be looking for? That's a really good question, actually. So everyone's different, obviously, but a good rule of thumb is to have a bit of a review kind of once or twice a year. So obviously recent market volatility that we've seen probably meant you checked your pension or your investments a bit more often, and that's absolutely fine. It's all about kind of avoiding rash or emotional decisions. There's a really good reason for the saying time in the market beats timing the market. But when you are doing your review, whether you choose a little bit more often than once a year or you stick to that, that's absolutely fine. Look at charges. Look at the investment case for what you hold. If you're someone who has a portfolio of investments that you manage and you have an asset allocation in mind, so how much you want to put in shares or other types of investments, or actually more detailed, so how much you want to put in UK shares versus US shares, for example, you might want to rebalance it at your review if it looks a bit out of kilter. So that's generally if one part has performed a lot better than the other and your original weightings of what you wanted to invest in are slightly off compared to before. You might also want to review your pension at different life events as we discussed in the presentation. So there's no kind of hard and fast rule, but I definitely agree with not tinkering constantly, but also not completely forgetting about it, because that's how we get into the lost pension arena. Also, one tip is don't forget to get a state pension forecast. I did talk about the state pension earlier in the talk. Again, it's not something you have to get every year or anything like that, but lots of people have never even checked their national insurance record or how many qualifying years they have for the state pension and what they might be able to get. So yeah, just go online, go to the Pension Service website, and you will be able to do your own state pension forecast. Okay, next up. Can transferring pensions make you more vulnerable to fraud? What red flags should I watch out for? And how can I make sure I'm using a trustworthy provider when combining? Well, I will say pension fraud, all types of investment fraud are constantly evolving. The main red flags for me would be unsolicited contact. Okay, absolutely ignore that. Anyone contacting you out of the blue, whether it's a text message, a phone call, social media, that is to be ignored, okay? This is a decision that you're kind of making for yourself. You're having a review of your investments and you're combining them. Anyone offering a free pension review, offering to introduce you to an investment opportunity, again, huge red flags for me. Another one specifically relating to pensions that we see is people offering ways for you to unlock your pensions early. So before that age 55 at present or age 57 from April 2028. That is not possible. So anyone kind of offering a scheme where you can loan or you can, like I say, unlock that pension early it's very likely to be fraudulent and could land you with huge tax charges as well. Pressure tactics, like in anything in life, anyone, buy now while stocks last, this opportunity will go if you don't sign up this afternoon. Again, that is a huge red flag. Any genuine investment will not come with those pressure tactics. And again, anyone pressuring you to consolidate, if you're not ready, walk away. Another one, very high or guaranteed returns. My kind of adage when I used to train some of our customer service staff here was the shinier the brochure, probably likelihood that something is a bit more fraudulent, shall we say. So again, promises of guaranteed of really high returns. Anything that seems or feels too good to be true often actually is. So I hope that's kind of a decent list of red flags to watch out for. And when you're transferring yourself, deal with that pension company directly. Do your due diligence. Have a look at their financials. Have a look at their strength. How much capital they hold in reserve. Talking about that capital adequacy before. Also cross-check their details on the FCA register to check that you're actually dealing with someone from the company that you intend to deal with. All that leaves me to do is to thank you so much for your time and for your questions. Like I say, I might not be able to get an answer to all of them, but we will have a look through and try our best. Thank you for joining me tonight and have a lovely rest of your evening.